Thank you so much. Yeah. Everybody hear me okay? We good? All right. We're going to try and keep this, feel free to keep this interactive. If you have questions or thoughts, feel free to contribute, because if you're thinking it, odds are someone next to you is also thinking it as well. So yeah, my name is Neal Wilding. I'm actually up from Louisville, Kentucky. Any Cardinal fans in the room? Maybe one. There we go. Yeah, so I graduated from the University of Louisville in 1996 and immediately found myself in the financial services community, working with advisors and their clients around their retirement assets. And immediately I found myself asking questions like, well, what could go wrong here? You know, and I started thinking about, like, that is just how my brain works. I'm a blast at barbecues and parties, let me tell you, because all I'm thinking about, like, what could go wrong here? But that was really was my focus. In fact, I'm also a music buff. I love all sorts of music, and there's an artist out of Alabama that's got a song out here in the last couple of years, and the lyrics of that song says, "The more you have, the more you have to lose, and that's what keeps me up at night." And that lyric was probably not written about your portfolios, but I also have 3 kids, right? And clearly that lyric is written about the relationship with your kids. And the more you have to lose. And I think if we've had children, grandchildren, we lay awake at night just worried about those kids. My youngest just turned 16 a year ago, which means now I have 3 drivers in my family. So you talk about worry. Boy, does that present itself when a child or grandchild gets in the car for the first time, right? But that's not here to talk about my family or my worries. Instead, though, I really built my career around identifying emerging risks, right? Because when we talk about worry, that's really what we're looking at here is risk. And so if I were to just define risk, if I were to Google it or ChatGPT it or whatever, there's a definition that would pop up. It says, the possibility that actual results of an investment or decision may be a little different, right? May turn out differently. And if we're worried about it being less favorably, right? That's risk. That's financial risk. I'm a simple guy. I simplify things. I simplified it down to the potential impact from uncontrolled outcomes, right? That's really when risk becomes present, is if we don't have control on what could happen, right? There's tremendous risk there. And so when you think about uncontrolled outcomes and risk and try and apply that to our retirement portfolios, most people, like if I say financial risk, where does your mind go? Right? Most people, and when I started in the business back in 1996, everybody's mind went to the market. And it's like, okay, obviously, the market can go up or down, and based on how the market goes up or down, my portfolio has direct impact. And the way that we can help find controlled outcomes are through how we manage our assets, work with professionals like Goldstone here, and they help take care of that. And really, for the longest time, our industry was only focused about market risk. But then something happened, and this is where I really started to enjoy our industry, is you have other kind of threats. Like you start asking yourself, what else could go wrong? And so in late 90s into the early 2000s, you had a couple of things going on. One, you had the dot-com bubble burst. That was shortly followed by the financial crisis. And so both of those two watershed moments happening in a 10-year time frame. It was the first time ever in a 10-year time frame the S&P was actually down over a 10-year time frame. And so that was obviously market risk. But what you also had was an aging population where people are starting, like you all, are starting to reach retirement age. And they realize, oh, if I go and take a distribution from an account value that's down, like that means either less income or I'm taking more than I was planned. And it presented this new type of emerging risk, which was, I'll just kind of call it income risk, or where do we need to seek controlled outcomes? Well, in our income planning. And I imagine that's why you were working with Goldstone here, because they specialize in that, not just mitigating market risk, but also bring the income planning into it. But where I see this other kind of emerging threat, like when I say, the more you have to lose, and that's what keeps me up. Like what keeps me up is this other emerging risk, and that's where we're going to spend some time talking today, which is around taxes. And in our books, we coined that legislative risk. The title of the session was Washington in Your Retirement, right? And so I ask a question. If we are paying our taxes today at, say, a 20% rate, right? So 20 cents on the dollar. And then suddenly legislation changes where they need more revenue. And so maybe now they need 30%. Is that less money in your pocket? Like that's like the more you have to lose, right? And so what we start to learn is that obviously when we construct our portfolios, and when we identify risk, we have to incorporate the market and build, that type of risk into what we're doing. And as we build our income plans, of course we have to do that. But what we have to also start looking is how and when our money is taxed. And because we always have new government, every 2 years there's new government. Whether it's new Congress, whether it's new president, there are always elections. And so if we're going to have a long retirement, that means there's a lot of uncertain outcomes that could present risk in our portfolios. And so let's explore that a little bit. Does anyone else share that concern? Right? Like that, yeah. And so is it real? Like is the rise of taxes, the risk of rising taxes, is it real? And why might it be real? Why might Congress at some point say, you know what? We might need a little bit more revenue here. The answer to that lies within the good old-fashioned balance sheet, right? Anybody looked at the balance sheet of your personal business? You probably look at it daily, right? Your personal income, you look at your balance sheet all the time. Money in, money out, let's make sure we're doing okay here. Our country isn't as disciplined at this, especially at the federal level. So I'm gonna look at the balance sheet because they have to publish it. And the numbers can be a little staggering. So what I have here is a document from 2024. It's out of the Congressional Budget Office, and it just looks at the money in, money out, right? How much revenue are we bringing in, and what are the expenditures that we have going out? This is not the fun part of the presentation. Let's take a look though, okay? So total revenue. Not bad. We brought in $4.9 trillion of revenue. Have you ever just written a trillion, like written all the numbers? Like that's a lot of money. That's in 2024, we brought in $4.9 trillion of revenue. And so revenue for our country is what? Taxes, right, income taxes for the majority. The majority of that's income tax, right? But tax revenue, $4.9 trillion. You would think that a country that's bringing in $4.9 trillion of revenue would not have trouble balancing their budget. But we know the story, right? All right, so let's break down our spending. Let's look at it. So first, there is certain spending that happens within our country before Congress even meets. Before they gavel in a law, before they even look at any initiative, there are certain mandatory expenses that have to happen, right? And then actually, the first group represents $4.1 trillion of mandatory spending. Anybody want to think about what goes into that category? Medicare and Social Security. Medicare and Social Security. Those two items alone represent $4.1 trillion of spending for our country. There's a third item that is in addition to that, that is an expense for our country before we even begin to protect it, before we even begin to service our roads, before we do anything else. There is a third item. Anybody else want to guess of what item might exist $800 trillion on net interest on our debt. Or I'm sorry, 800 billion. Yeah, 0.8 trillion. It's just a comma, a couple extra zeros, right? Thank you for setting me straight on that one. Yeah, so think about that, right? So we have two items, Social Security, Medicare, driving $4.1 trillion of our revenue. And then, oh my gosh, we got to pay off our debt. We got to service that. That's just the interest on our debt. That's 800 billion. So you add those two together, we got a balanced budget. Well, every 2 years. No. So $4.9 trillion. Again, we're balanced. But see, Congress does meet, and they do pass laws. And we do need to defend our country. We need to fund a military, of course. We need to enhance roads. We need to have government programs in place. In the fiscal year 2024, we had $1.9 trillion worth of what I'll call non-discretionary spending. And that's where Congress has met and built a budget and decided how much are we going to spend this year. That was another $1.9 trillion. So, my little math here tells me that the number on that side is a lot higher than the number on that side, and that is why we are living and operating really as a deficit spending country. There's this one is a little more accurate here. $1.88 trillion is the exact number of additional spending that we had as a country above and beyond the revenue that we brought in. And that is why the national debt continues to escalate, and we are marching towards a $40 trillion national debt. So I ask, like when we're like things that keep me up at night, and things that could go wrong, and emerging risks to our retirement portfolio. Obviously, the market is there, and so if we're going to build plans, we need to incorporate market, asset allocation models to represent market risk, and we need to have tools in place to take care of our income planning needs. But the fact that our country has this type of balance sheet, do you think there's a time where at some point, you know what, we might need to generate a little bit more revenue? Yeah. So let's talk about this a little bit more. Where can we facilitate change in this? Where could we facilitate change? So 4.1 trillion. Remember, what did we say that represented spending? Social Security, Medicare. All right, so that is a math problem, right? Because our population, we have more people retiring today than we ever have in the history of our country. That's not changing, right? Like those are demographics. Those are set in place. That's not changing. Okay, so we can't facilitate change in that one. What about net interest on the debt? What are the two factors that dictate how much interest we have to pay on our debt? One is how much debt that we have, and the second is what the interest rates are at that point. Right. Interest rates have normalized a little bit here. And so we're paying a little bit more on interest than we were 5 years ago for sure, right? But the challenge here is even if interest rates were zero, that number is still going up. Why? Because we keep adding to it, right? Like it's almost like having an interest-only mortgage, right? Like we're not taking care of the problem. In fact, it's like we got an interest-only mortgage and we're adding to the house. And we're adding to the house, and so the number's going up, up, up. So that 800 billion, 0.8 trillion, is a number that we can't really facilitate change there. So, hey, I got the idea. I got it. Here's the idea. Oh, wait. Before I reveal the solution, let's talk more about 800 trillion. That number is alarming in two ways. One, it's just getting out of control. We look at the line items on what we're spending money on as a country. Did you all realize that in 2024, we spent more money on interest serving our debt than we did defending our country. The budget for our military is less than our budget for servicing the debt. That is a growing concern. But there are solutions. Hey, I got a great idea. Maybe we can just have Congress spend less. Let's not hold our breath, right? All right, that's just not the behavior of Congress these days. So if we need to facilitate change and we can't do anything about Social Security and Medicare, we can't do anything about the $800 billion and growing service to our debt, and we know Congress is going to continue to spend money, where can we facilitate change?
Tax cuts.
Oh, well, wait, we'll get to that. Yeah. Wait, we kind of went the wrong direction on that, but that's okay. Yeah. We're eventually, at some point, if we are treating this like a real math problem that we need to solve in the real world, where does that change come?
Yep.
Probably here on the revenue side. Now, to your point, we did have the one big, beautiful bill. Okay, I'm not here to talk politics. I'm not here to talk the merits of the bill. Because, hey, you know what? The tax cuts are great for us, right? When we go to fill out our return, we're going to pay less in taxes. And that actually benefits a lot of us. And the funny word, I think, that was attached to this bill is because the tax cuts we're talking about here, right, were the Trump taxes in 2017 were passed by Congress and signed into law by the president in 2017, but they were going to sunset. Those tax cuts were going to sunset. And so what we did is we took tax rates that were here and we made them artificially low, stimulate the economy and do things that the tax cuts can do. We did that, but they were due to sunset this year. But then Congress met this year and there was great debate. Would we get an extension to those tax cuts? Would we go 5 years? Would we go 10 years? And where did we land? Does anybody know? Permanent. 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 Yep, they're permanent.
Well, actually, until the next one.
Bingo. That's right. That's right. There's a CPA out of Cincinnati I mentioned up the road from me, and he was quoted in the Wall Street Journal. And you know what he said about tax policy? He said it's written in pencil. Tax code is written in pencil, can change at any point. We just need new government. And so what this bill does, though, it does give us some runway to take action. Because I used the term to describe our tax rates being low. There's an adjective I put before that. They are artificially low. Our economy does not support where tax rates are today. They are artificially low. And so that does present a planning opportunity. And that's why we're here to talk about this. I'm not just here to talk about how bad things are. Trust me. I'm here to talk about the opportunity that we have to do some planning. Okay, so could my retirement be impacted by Washington? Could it? Where does it present itself? I'm going to talk about how taxes can change, right? There's a couple of different ways taxes can change. It could just be simply, like when you think about tax rates and when we talk about the tax cuts, what's everybody think about? Their tax bracket, right? And what tax bracket am I in? And what's my income? And what's the rate applied to that income? And then that tells me on April 15th what I have to pay in taxes. Brackets, that's where everybody thinks of. But see, there's another way your taxes can change. Where'd it go? I'm missing a slide there. Tax bracket change when they just go and change the rules. Right? Congress can change the rules and they can pass new laws. They can find new ways to tax you. They can find different ways to tax you outside of just the income tax. So let's start first on just the changing of brackets. So if we had new government and new government looked at the current policy and they're looking at our budget and they say, oh my gosh, we have 4.9 of revenue and we got 6.9 of spending, we got problems, we need to fix things. If they did and they said, you know what we could do is change the brackets. Historically, I said that they are artificially low, and I can prove that by looking at the Census Bureau. So there's a census term called the middle quintile. It basically just represents the average American taxpayer. I did some work, and I looked at what the average American taxpayer paid in 2000, so just 25 years ago, and compared that to what the average American taxpayer is paying today under these current, the Trump tax cuts that were passed in 2017 and that were extended, quote, permanently. Anybody want to guess at how much higher taxes were in 2000 compared to where they were or are now? I'm talking about an effective tax rate. So if you look at whatever your effective tax rate, if you compared it to what it was then to now, for the average American taxpayer. 5%. 5%. Do I hear higher? 10%. Do I hear higher?
10%. 30.
30. The average American taxpayer, if we were to apply the tax rates of 2000 to their income on April 15th, they would pay 30% higher than they would today. So when we talk about tax rates normalizing, that's a significant change. What could go wrong, right? What were we losing sleep over? If we are deferring taxes into a rising tax environment, these are potentially the taxes that we could be looking at. All right.
In this calculation,
yes.
Are you taking into account changes like reducing the amount of real estate tax I could deduct today compared to 2020?
Yeah, so good question. So his question is around, are you taking into account the deductions and not? No. So what we're looking at really is just tax bracket rates. And there are far more factors that go into the calculation of your specific taxes versus a broad generalization. So in order to do stuff like this, we have to keep things broad. But yeah, there are certainly other ways that are out there. All right, change brackets. As I mentioned, another way taxes could change is we change the rules. Or Congress changes the rules. Said another way, they come up with new ways to tax you. Is anyone currently on Medicare paying their Part B and D premiums? Did anybody get the surprise of Aunt Irma? Does anybody know Aunt Irma? Aunt Irma. That's an acronym. By the way, nobody knows what Irma is until you got to pay it. Irma, what is Irma? The income-related monthly adjustment amount, right? Hey, good news though, it's not a tax. It's not a tax. It is a surcharge that's applied to your Medicare Part B and D premiums that comes out of your Social Security. So net, there's less money in your pocket because of it. But don't worry, it's not a tax. It's a surcharge, right? So
After tax.
it does. It comes out after taxes. That's right. Yep. All right. So Irma, I bring that up here really for twofold. One, for what it is, which, hey, listen, I'm going to call it a tax. It is a tax. And when it was passed, it didn't make a lot of news because it wasn't associated with your bracket, right? It didn't take your tax rate and go from 20 to 22 or 24 or 26. But it was a way to raise revenue, right? And so, and it's actually proven to be a very successful way to raise revenue. But also, I feel like what it represents potentially is if we have a Congress, we have a new government, and they're like, what are some ways where we can raise revenue without telling people it's a tax? Well, what about these income-related things? Like, these work well, right? And so it's not alone, right? When you start to think about when you have your income level that's on your return, they use that number for a lot of things. Income tax alone, right? The more income you have, the higher the tax rate you pay. What about Social Security? That actually just changed with one big beautiful bill, didn't it? Right? So anybody know how that works a little? No taxes on Social Security, sort of. Sort of. Right, but what do they look at to see? They look at your income, Right, they're going to phase you out. If you make too much money, you're not going to get all of that. You're not going to get all of that subsidy, right? And technically, it's like it's an offset, right? It's increase your standard deduction, basically, is what they'll do, but only if you make enough the amount of money they think it's okay for you to get, right? But so income related, this falls in that category. Anybody sold any securities lately, like and had to pay a capital gains tax? What do they look at when you pay a capital gains tax? They look at your income, right? More money you make, more you pay in capital gains. Yep. And then, of course, now we got this Medicare Part B and D surcharge. It's not a tax, surcharge. And that is another new way where they're starting to raise revenue, and it's all tied to what? Your income, right? And so that is becoming a more and more important number that is used in calculating more and more taxes. All right, so the challenge with IRMA, I talked about legislative risk and new government government coming in and the ability to change. The challenge with IRMA and the income related, that is already written into the law, the fact that the rates can go up, right? The surcharge that you pay on your Medicare Part B and D goes up every single year. And it's not tied to cost of living. It's not tied to inflation. Anybody know what the increase is tied to? It's tied to experience. Meaning they look at how much Medicare was paid, right? It's calculated the same way your health insurance premiums are calculated. Like I know ours went up a lot more than inflation when I was building out our company's insurance plan. Right? It is not tied to inflation, it's tied to experience. So the more people that are using and filing claims, the higher that adjustment comes. Historically, that number has been, every single year, it's gone up between 4 and 8%. I'm talking about that surcharge, right? So that surcharge has gone up. Last year, it was 5.9%. Actually, they did us a favor last year because it was low. Like the last 5 years, on average, since 2019, it's been 7.1% increase. And so when you start to think about these income-related charges, particularly around IRMA, again, you don't know about it till you got to pay it. And it kind of smacks you in the face and you see it and you're like, man, I wish could we do something about this? Well, it's tied to income, so we can. But the challenge is that number's going up every year and it's going up faster than inflation. And so that means it's a growing impact to the bottom line if you have to pay it. So what you're looking at on the screen there is a cover from a document that the government has to put out. So for every government program that is out there, Social Security, Medicare, anything that's a government program, there is also a trust fund that is set up that then supports that program. Some of them are well-funded, others are not. More and more are falling into the not category. But you know what's doing okay? The trust fund that supports not Medicare, but Medicare Part B and D. In fact, it is the single most successfully funded trust fund of all of the government programs that we have. Why do you think that program might be so successful? Because they can raise price. It's already written into law. They can look at the expenses and say, you know what, if we have higher expenses on this side, we can raise the price. And so that surcharge has been the saving grace to the Medicare Part B and D trust fund. In fact, they've said that, to adequately meet expenses, probably at some point, and they say here, that's the reason, because beneficiary premiums and cost-sharing payments have been established to annually cover the expected costs. So they found something that works. In fact, it works so well, they're saying that some people, at some point, they're going to have to raise it to the point where it just takes up your entire Social Security check. That's there. Now, that's good news, right? Good news. We got a government program that works. Well, why does it work? because we got to pay for it. And we got to pay for it at an escalating clip. And so what concerns me is that if we have new government, and we have new government that sees an economic problem, and they see the budget that we have, and that we're spending too much money, and we have to find a way to raise revenue, and one of the most popular things you can do as a politician is to raise taxes, bracket rates. But we have this successful program over here in IRMA, and they have to address it. Don't you think, what's a way where this is working? And they're going to look at IRMA, and they're going to see the success. To me, it's going to become the future of taxation, and certainly the tax increases, where, okay, well, if we need to raise revenue and it's unpopular to change the brackets, I'll just change the rules. And we'll come up with new ways to generate revenue where the people that voted for me don't realize that I'm taxing them more. Like, it's a very skeptical way of putting things. But when you have something that works, don't you think? Like, it happens in movies. It happens in music. It happens everywhere. Where if you got something that works, like you see a good movie. We don't see many of those anymore. But if you go see a movie, right, and it works and a bunch of people go see it, what's Hollywood do? They go make 10 movies just like it. I see the same thing happening here. They have a way to tax people that is a very successful funding of the trust program, or the trust fund that supports a program, and it works. Well, maybe we should go do some more things like it. Okay. All right. One more thing about taxation before we get to how we can solve all of this is there are some tax changes out there that can have significant impact to your taxes without government even changing the rules. There are some times where our situation changes. And if our situation changes, sometimes it could impact how our money is taxed. There's a term in our industry called the widow's penalty. And basically it just means that if we have a married couple and married couple married filing joint, and then we have one of a spouse passes away, if our income needs are the same or similar, suddenly now we have the same level of income, but we're paying taxes as a single filer instead of married filing joint. Have you looked at the difference between the two tax brackets? They're significant. So if I were to quantify that for you, anybody want to guess, on average, how much higher the taxes are in this scenario if we're now filing single compared to what taxes were when we were married filing joint? Now I'm talking the same income level here. All right.
100%. 50.
It's 32.4%. That is an increase to their effective tax rate. So for example, if we're at 100,000, right? If we're at 100,000 of income, your effective tax rate would be about 11%. For 100,000 now for a single filer, we're at about 16%. That's 5, but that 5% of 11, that's 40% increase to your taxes. So it is real. And that average is based off to taxable income up to $500,000 a year. And actually in this case, the widow's penalty is more significant the less income you have, because it represents a greater percentage of your base income. All right, we ready to start getting to solutions? Yeah, let's talk. Okay, how do we address this? I told you, Bruce, I said I might have to stir him up a little bit. All right, so we're going to address, because the thing is, and that's why I've spent my whole career doing this. We got to see it before we can fix it, right? And we have to see it and identify it. That's true in sports, it's true in life, it's true in business. You can't address a problem that you don't see. And so how do we address the risk of rising taxes? I'm going to take an average or a sample client here, 60 years old. Let's say he's got $1.5 million in his IRA. I'm just going to look at $500,000 of it. So a third of his money, and we're going to assume it's growing at 5%. We're going to assume it's taxed at 20% effective tax rate. And what I want to do is calculate the total amount of taxes he's going to pay over his lifetime. I like to call that his retirement tax bill. Right? Total taxes we pay over a lifetime. If we are in an IRA or a 401k, it's become a very popular way to save. And so if that's the case here, let's assume all of this money is in one of those IRAs. Okay? There are the government actually gets 3 stabs at your money when the money is sitting in an IRA. The first is what? Through distributions, right? So whether we're just taking level income, for some people we don't take the money until we have to, and what are those called? Required minimum distributions, right? So let's assume this one, we just let it grow until the government tells me he has to start taking money out. Through required minimum distributions alone, that $500,000, remember, I'm not calculating the 1.5, I'm just looking at 1/3 of the money. So the total tax bill on that would be $190,000, just through the RMDs alone. Now, some of you, when you take that money out, you spend it. Others, like, I didn't need that distribution. That means we're going to be saving, but are we saving under the umbrella of a tax deferral anymore? No, now we're in a taxable account. And so the money, if we continue to save, that was taxed on the way out the door of the IRA, continues to get taxed. As it grows, that would be another $60,000 in taxes on that alone. Now, when we pass money on, inherited IRAs, are those taxed? Yeah, unless they're going to charity, right? They are taxed. And so, in this case, there's another $183,000 in taxes paid at death. So the total tax bill for this $500,000, $434,000. Now, good news, your account grew. Like, the reason these taxes are high is because you continue to grow. That's good news. Challenge is all that growth was also subject to all the taxation. All right? All right. Now, is there an exit plan? Do we have to continue to defer taxes into the future? Do we have to stay in a traditional IRA? What could we do? We could do a conversion, right? Roth conversions have become very popular. How does a Roth conversion work?
Pay your taxes up front.
That's right. Go ahead and pay them now, right? Taxes are artificially low. Catch them while they're on sale. Pay them now, right? Okay. That would be reallocate to tax-free, right? And those options are there, right? Challenge is, well, you got to pay them now, right? Like, but that is part of the solution here. And so if we took that $500,000 and we were able to convert that money to the tax-free side of the equation at the same tax rate as we would be taxed if we just deferred at 20%, you'd pay $100,000 in conversion. Good news, is it taxed? None of the growth is taxed. Are Roth IRAs or tax-free instruments, are they taxed at death? No, zero. Total tax bill, $100,000. It seems viable, right? Not bad. Now, my analysis is a little flawed. I don't know if anybody caught it, but I said, oh, let's just assume the money is taxed the same way during the conversion as it is over your lifetime. Like, what happens if we take, let's just say we spread it over 5 years. Okay, so $500,000, we're converting $100,000 a year. That means your income goes from whatever it is to $100,000 more. Right, and so that means $100,000 more means what? You got to pay a little bit more tax, and you might even trigger some IRMA. You might have some stuff going on there. I'm not saying it's bad, but we got to understand what could be going on there. So let's just say that drove up my tax rate by 5%. Well, so now instead of paying at 20, now it's 25. Okay, well, it's 125. So you tell me. So it may be worth considering going ahead and getting out the door, even if there might be some side effects here and pay some. Yeah, guess what? The other number, the 434, is flawed too. You know why? Why are we even considering a Roth conversion in the first place? Why are we considering moving money to the tax-free side in the first place? Because we feel taxes could be higher in the future than they are today. I just showed 20% the whole time. Well, that's a flaw. What if we just showed the taxes going up by how much? Could they go up? Like, if taxes normalized to the year 2000, that'd be a 30% increase. So that means my effective tax rate goes from 20 to 26. So now, more like $558,000. My tax bill's going up. Now, what's the third line item there? Remember, we said the IRS gets 3 cracks at your money. First, through RMDs. Second, through the growth of those unspent RMDs. What's the third line item? At death, inherited IRA. Oh wait, what did we say could happen when the assets are taxed and we go from a married filing joint to now single? Taxes can go up because now we're filing on a single. So I didn't model that. So now I need to effectively consider, So now if I assume that increased tax at death, suddenly that number in green over there just keeps going up, 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 right? That is the perfect example of the more I have to lose, and that's what keeps me up. But on the blue line, once we go ahead and pay our taxes, once we go ahead, do we lose sleep at night? No. Because we have known outcomes, right? Well, what did I talk about? My definition of risk is how do we, the risk is present if we have unknown outcomes. Now, is it potential that taxes could stay flat forever? I mean, I don't know. They're permanent though, right? They're permanent. No. I mean, is it possible? Yeah, it is not good for our country. We're probably defaulting as a country if we don't. But we have to find other sources of revenue. And so likely we will have to. But I'm not saying that they will. I'm just saying that they could. Right? When we talk about market risk, does anyone have 100% of their assets in the most aggressive thing that earned you 50% last year? No. Why? Because it could go down. Right? Sometimes it goes up, but it could. That's why we need to allocate and find some of our money and move some of our money to more conservative instruments where we have controlled outcomes. Right? The same applies here with taxation. I'm not saying taxes are going up. Boy, I've painted a case where they really need to. But just the fact that they could makes me think, maybe we should be moving some of our assets over to the tax-free side. Because I like sleeping at night. Right? And that just allows and provides an element of safety. All right. So good news is, because you work with Bruce and his team here at Goldstone, everyone can get your analysis, right? So we can run this retirement tax bill for everyone here, and it's just going to be a super simple, high-level analysis. It's not going to take into account some of the details that we talked here and where we can write things off and other things like that. Just a nice high level of analysis, and we're going to say, okay, what would your retirement tax bill if we just continue? And this is really narrowing in on the assets that are still in IRAs and 401ks, tax-deferred instruments. And we say, does it make sense to move some of that money from the tax-deferred side to the tax-free side? And so just get your own numbers, and they can run it for you. And then when you sit down in the planning process, you can kind of talk through, whether it really makes sense. So I do want to just make one other point, is that we spent a lot of time talking about Roth IRAs because a lot of people know what a Roth is now, thankfully. Not just our industry, but you've probably maybe even already done some Roth conversions working with Goldstone here. But it is not the only tax-free option. It is the most popular because it's what people know. And a Roth conversion does a great job of eliminating the tax risk that we've talked about, right? Because if we pay our taxes through the Roth conversion process at known rates today, we eliminate all that risk and I can't sleep at night stuff that comes with a conversion. It does a great job. But there is a small slice of risk that still comes with it because when you go to the tax code, does anybody know the tax code, like the book where it talks about our IRAs? It's Title 26 of the tax code, and you actually flip to a page in the book. It's page 401. 401. And then you go to page 401, and then you go in parentheses, you go to section K. That's why I know it, right? Everybody knows 401k, right? You think 401k is a product that I buy when I'm saving for, working. But really, it's a section of the tax code, right? And it's a section of the tax code that says if you save your money in a specific way, it is taxed as tax-deferred money, right? IRAs, just a little bit further in the tax code, right? And so, and Roth IRAs, under that same guise, right? And the challenge here is when we are doing a conversion, whether it's an IRA, a 401k, or even a Roth, those assets are in an account. They're in an account. And the taxation and the rules of the taxation rules of that account apply at the time of distribution. So if they change the rules, you are subject to those rule changes. Now, I'm not saying Roth money's going to, once you pay a tax on $1, they can't make you pay another $1. But they could certainly change access to Roth. My man's skeptical of that statement. Yeah, I mean, they can. I think that's very unlikely. But it does. When I talk about legislative risk and the risk that Congress can change the rules, it's very present. It happens to our IRAs, 401ks, and even Roths, where, like, for example, the Secure Act that was passed in 2019, the Secure Act changed the taxation of inherited IRAs. Non-spousal beneficiaries used to be able to take that inheritance and they could spread it over their lifetime. And so we had people that were, maybe some of you, that were in trusts established to set up a stretch IRA over their lifetime based on the current law at the time. Well, the Secure Act changed that rule. And they said you can no longer, as a non-spousal beneficiary, unless you meet very specific requirements, you can no longer stretch that over your lifetime. If you're a non-spousal beneficiary of an IRA, anybody know how long you have now to pay your taxes?
10 years.
10 years. That's right. Is that a significant change? For a lot of people, yes. And was that rule present the day you opened the IRA? No. They changed the rules. And so that's a risk that is present. And so in my strategy, I wanted to look for, I have Roth money. I am confident in my Roth money. I think it does a great job of offsetting tax risk. But there is another way where we could take it a step further, because there is another financial instrument that actually is more of a contract. And it's further back in the tax code. It's on page 7,702, 7702. It is the taxation of life insurance. And life insurance is a challenge because you have to qualify for it. You have to qualify for it. And so it might be worth considering, because does anybody know what happens when they change the rules on life insurance contracts? This happened in the 80s when they had the tax law and they changed. It was called TEFRA and TAMRA. And there was a life insurance, and cash value inside of life insurance was taxed a different way. And they changed the rules. But you know what? The people that had those contracts already established, they were contracts. They could not change the rules. They were grandfathered in. And so life insurance, I only bring that up here, and Bruce and his team, they know the ins and outs of this. They know the marketplace well. And so it might make sense in our Roth conversion strategy here to maybe use for some of the money, start thinking about and see if you qualify for some life insurance, because it does provide, I mean, for one, I mean, it's a death benefit and it's a nice way to pass money to our heirs, but it also provides an extra layer of protection from this legislative risk. Because we got new government every 2 years, right? And the policy that's in place now, permanent, it's not permanent. On average, permanent tax laws usually last 8 to 12 years. So we do have some runway, and we have some time to work. But that's the beauty of identifying a problem now, is that we have some strategies that we can apply, whether it's through some, like a Roth conversion, whether it's cash value life insurance, which these are engineered now as savings instruments. This is not your grandfather's life insurance. These are sophisticated financial instruments designed for saving. And they're designed because of the section of the tax code is so beneficial. We're like, what are we doing if we don't take advantage of this? And so it's worth sitting down. So in summary here, when I think about Washington, like, we have new government every 2 years, every 4 years. Things can change. And so if we're trying to identify things that kind of keep us up at night, we got opportunity to do some planning here and make that go away. I like to finish things with a quote. And the quote is from this man. Anybody know who that is? If you do, No. If you do, I'll buy you a bottle of bourbon. It's Peter Bernstein. And Peter Bernstein is in my circles, he's a lot smarter than I am, but he thinks like I do. And he spent a career identifying risk. And he had a quote that he says about risk. What he says is, the greatest risks are the risks that we don't see. And the most difficult problem is preparing in advance for something that we don't see. The good news is, hopefully, if I've done anything on my trip up here from Louisville, Kentucky, I've just put your eyes on something, right? And just start thinking about legislative risk, tax risk, and just start to think about that. Because now we can't say it's one that we didn't see coming, okay? That is a wrap. Now, part of being at this meeting here, like I said, Bruce and his team have access to some reports they can run. He can run your total tax bill, your retirement tax bill. IRMA, we can also project out what those IRMA payments, if you would be subject to IRMA, and if reallocating to tax-free can get you some tax savings. So they have access to some reports. So when you book some time with Bruce and his team, you're going to be able to at least see if some of these strategies might make sense. All right.
Thank you, Neal.
You're welcome.